Okay, so if you're just joining us, I mean, could we make it any clearer? It's perfect, right? The Fed cut by a quarter point in case you can't read the block writing.
Right, and in case you can't read what's over my left shoulder, the market is now up 66 points, pretty healthy on the upside. The Federal Reserve Board, of course, didn't want to panic either one way or the other. At first, it was about flat, but now they're deciding they like the news. That could change by the end of the day.
So is today's Fed move a good move for America?
Joining us now, our Fox panel, Mike Norman, founder of Economic Contrarian, who is dying to get into the Steve Forbes debate there. Charles Massimo, president of CJM Fiscal Management. Nicole Ridgway, senior writer of SmartMoney.com. Peter Schiff, CEO of Euro-Pacific Capital. Before we get into Peter and Norman, who are going to dominate this conversation, I want to go to you. What do you think of the move?
Well, again, we're in the camp of you're a passive manager. You ignore this short-term information. But having said that, I think you got to be pretty encouraged. You have an economy where GDP is rising and interest rates are falling, which historically is very good for an economy. But more than that, the markets today and the economy today is controlled more by human psychology than anything else. And the psychology of the market right now is pretty positive. When you have short-term rates coming down, people who own mortgages feel a little bit better. They have a little bit more room to expand on their credit cards. So all that, I think, equals to at least a short-term positive move for the markets.
And my GDP came out looking pretty healthy today, but the dollar is not healthy. It's got an IV drip stuck in it right now.
Look, Liz, we added $53 billion in the third quarter in exports that contributed almost 2% to GDP, almost as much as personal consumption, all right? The weaker dollar is definitely adding as a stimulus to the economy. We had $100 billion in economic output in the third quarter when we had all these problems with housing and everything else.
My dollar doesn't buy what it used to, Mike.
Oh, yes, it does.
No,
oh, absolutely it does.
Maybe
if you take a trip to Paris or London, it's not going to buy what you used to.
Okay.
But within the United States, the money that people earn right now, wait, Liz, this is very important. Real earnings now are the highest in 27 years.
Okay, hold on. Peter Schiff, take it, and let's get off the dollar here and talk overall about what it means for the person who's out there watching.
Well, the person who's out there watching has dollars. I mean, unless you're one of my clients, Euro Pacific Capital clients don't have dollars. I've been helping my clients get rid of their dollars for years. We own euros. We own Canadian dollars. We own Australian dollars. We own foreign stocks. We own oil. We own gold. So if you own those things, then this is not a disaster. But if you're the typical American who has dollar income, who has dollar-based investments, your wealth is evaporating.
It is
right
not
beneath
evaporating.
Okay, hold on. We haven't heard from Jim Petticock. Jim, if you're looking at the big board, be quiet for a second, Mike Norman. If
Mike,
you're
you're the one that gives out
you're
misinformation,
looking
not
at
me.
some very positive numbers. It's up 72 now. So somebody's buying with dollars.
Well, that's right. And I think one reason the market's up is that I think investors, even though the market tailed off a bit at the beginning, I think they're hoping that the Fed knows something that they don't. That the Fed knows that the housing, as bad as it is, it's somewhat containable. Now I question that. I can't help but wonder if the Fed shouldn't have gone faster and further here, maybe gone 50 to get fully ahead of this housing problem. But you're right. 3.9% GDP with all these problems. I mean, that's an incredible number.
It's not real.
Nicole, are you with us here? Nicole Ridgway?
It's not a real number. Measure our GDP.
I think it is a real number.
Dollars.
Charles,
get a real inflation rate.
Okay, listen, hindsight's 20/20, but as we look back on all of this in a couple of years, will the Fed look like a hero or a villain at this time?
Only time is going to tell you. Peter somewhat alluded to it in the sense that if you're the right investor, if you're the investor that does it the right way and builds this broadly diversified portfolio, whether it's a combination, you can't just own European stocks because that eventually is going to come back to hurt you as well. But if you have a broadly diversified portfolio, what the Fed did today will mean very little in the next 2 to 3 to 5 years. So again, to make a decision today based on that is ridiculous.
Peter keeps repeating this thing, which is absolutely wrong, saying that those numbers are inflated. The numbers that are reported on GDP are adjusted for inflation. I told you that last time.
They're adjusted for the government's version of inflation.
So, okay,
Mike,
this is a classic. Somebody who doesn't know what they're talking about always reverts to, oh, so you're going to believe those numbers?
I don't know what I'm talking about, Mike.
Right? That's
for years, hold on,
Mike. Those are adjusted for inflation.
Quiet, Mike. Go ahead, Peter.
For years, I've watched you on television tell people that oil was going to go down, that gold was going to go down, that the dollar was going to go up. You've been dead wrong on every economic prediction you've ever made. Yet you're criticizing me.
The United States was going to go down the drain when we've added trillions and trillions of dollars in economic output.
Here, wait. Camera over to us. here's what you
This
really
is
need
where
to
the
know.
director has to follow the anchors.
You are a peddler of
Wait.
misinformation.
Quiet, Mike.
They actually love each other.
Yeah,
offhand.
right. Well, lost in all the excitement and reaction to the rate decision, a larger debate, do we need the Fed at all?
Our next guest says no. Joran Brook is from the Ayn Rand Institute, and Jim Petrakakis is from U.S. News and World Report, also here. He thinks Joran is way off on this. So we've got some conflicting opinions, and we may bring in another voice here, depending on what's going on. But Joran, tell me, why don't we need the Fed?
I don't think the government should be in the business of setting prices. And every time it tries, it's a disaster. Price controls in the 70s, the Soviet Union trying to set the price of bread was a disaster. The Federal Reserve setting interest rates is unnecessary. It's bad for the economy. I agree with Steve Forbes. Let the market set interest rates. Let the market determine what the Fed funds, the equivalent of the Fed funds rate should be. What the Fed does is it causes Great Depressions, inflations, bubbles, credit crunches. I mean, all these economic problems that we've had since the Fed was founded in 1913 are a consequence of Fed policy. We don't need it. Markets work by themselves a lot better, a lot smoother, with less risk.
Yeah, but Jim, doesn't the Fed also act as a lender of last resort when banks get in trouble, as they did in the Depression, as maybe they have now because of these mortgage-backed securities? The Fed is a useful instrument to act as a lender of last resort.
I mean, that's right, David. I mean, the reason we have a Fed is really to stem financial panics. I mean, that's why a Fed was started. And I mean, I can give you $14 trillion reasons why we need a Fed. That's the size of the U.S. economy. We've had a Fed for about 100 years. The economy is done pretty good. We're now worth $14 trillion. In the past 25 years, where we've had a Fed that has been that's really kept a very close eye on inflation, we've had 25 almost perfect straight years of economic growth in this country. I mean, if you're going to say get rid of a Fed, you have to provide some evidence that it's been harmful for America. I don't see where the evidence is.
Peter Schiff, what is the evidence? You agree with Joran.
I got the evidence. Look, we established the Fed in 1913. If you look at consumer prices in the United States, you go back 150 years before that, there was zero inflation. Prices were no higher.
Deflation.
Prices were no higher in 1913 than they were in 1780. Since the Fed was created in 1913, our money has lost more than 95% of its value. The Fed has done a terrible job.
Peter, did you miss the great disinflation? Have you missed the great deflation of the past 25 years?
I haven't missed anything.
It's like your clock stopped at about 1979 or something.
Hold on, one at a time, guys. One at a time. Peter, go ahead.
The Fed has destroyed the value of our money. All right? That's why you can come out with these numbers and talk about economic growth when the economy is really contracting in real terms. You know, look at gold's up another $5 in the last 5 minutes. You know, I'd put my faith in gold over a politician with a printing press.
You're on.
Well, not only that, but look at GDP growth pre-1913. It was far greater in real terms than it is over the last 25 years. And you can say 14 trillion, but the economy could be 28 trillion. I mean, we don't know how large the U.S. economy could be.
Jim, you're outnumbered. Hold on, guys. Jim's outnumbered. He's in the middle. Let's give him the last word. Go ahead, Jim. Go ahead, Jim. You're on. Be quiet. Go ahead, Jim.
Listen, the one good point here is really because of globalization and financial markets, these guys are like this. The Fed really has less power now than maybe it did 25 years ago. So maybe as markets expand and currency markets get bigger and interest rate markets get bigger, the Fed will be less powerful, and Peter and Joran will be
last word from Jim Petrakakis, Peter Schiff, Joran. Thank you, gentlemen. Appreciate it.
Peter's going to be happy to hear that gold just touched $799 a troy ounce.
Close, as close as you can get to 800.
We're watching.
But look at the... Well, here's the irony. A rate cut on a day we find out the economy is growing at nearly 4%. Just how bad does the Fed think the housing market thing is?
We welcome back our Fox panel, Gary B. Smith from Exemplar Capital, Nicole Ridgway, senior writer for SmartMoney.com, Mike Norman, founder of Economic Contrarian Update, and Peter Schiff, CEO of Euro Pacific Capital. We have security guards standing by Mike and
Keep
Peter.
it civil.
Just to haul them out. Nicole, let me let you get a crack at this. We had a really pretty decent GDP number here that showed that's gross domestic product, that indicates output of all goods and services in the U.S. So why is the Fed so scared?
Well, I think before this number came out, obviously there was this feeling that it was actually be a lot lower than what it came out to be. But, you know, the Fed is trying to do this balancing act between inflationary pressures and growth. And, you know, it's a lot of guessing in between. But the housing market is a legitimate concern, and they want to make sure that they can stoke the fires there.
It's inflation, Gary B., growth, and also concern about whether our banks are becoming decapitalized, whether they don't have enough cash in their reserves to service the people out there, the folks.
Exactly. Nicole brings up a good point. The Fed is in this ever increasingly hard balancing act between inflation and growth. You bring up a good point in that Nicole started it. It started obviously with the housing market. But when those mortgages were repackaged, it flowed all the way through the financial market. So I'm not sure the Fed was just saying, hey, I'm going to bail out all the people that had, bad, low teaser rates. They're saying, wait a second. This rippled, good or bad, through the financial markets. You saw the cold commercial paper, liquidity tightened up. That's what we're after, because that looked like it could head us into a recession. Just so people understand the concept of commercial paper. Now, then we have to defer to Mike Norman. I only know the sound bites, Liz.
Look, first of all, bank capital adequacy is still very, very high. Banks are still, sitting on excellent capital positions, so I don't think we really have to worry about that too much. The Fed, in its statement right here, it said, look, we had good growth in the third quarter, but there's a chance that the expansion will slow in the near term. One thing very interesting, which I haven't heard anyone talk about, is the fact that they say here the committee judges that after this action, the upside risks to inflation are roughly in balance with the downside risks to growth.
Translation?
Translation means they might sit for a while now because they're saying we see it in balance, upside risks to inflation, downside risks to growth. So what does that mean? If the market is pricing in, and we'll have to see over the next several weeks, the next month, if we're looking at an expectation of another cut in December, that might start to diminish. I don't know if that's necessarily a bad thing for the market, because it could be positive for something. I know something that Peter hates is the dollar, which might start to appreciate on this now.
Do we unleash the Peter?
We now unleash the Peter.
One thing that no one's pointed out today is even though the Fed irresponsibly cut interest rates again, the yield on the 10-year is up about 100 basis points on the day. And every single home building stock is getting hammered right now. If you pull up and look at the screen, they're all red, and they're all down 3, 4, 5%. And I think the way the dollar is falling, remember that all these mortgage-backed securities are bought by foreigners. They're the ones that have the savings. It's the Europeans, it's the Asians who have been lending money to Americans to buy homes, to refinance their mortgages. And when they finally realize that the dollar's a bottomless pit, they're not going to want to buy that paper. And interest rates are going a lot higher as a result of what the Fed is doing. They're not going down.
Peter, I just want to get back to one thing you said. Don't you think it would have been even more irresponsible for the Fed not to do anything and let us edge even closer, as I think they alluded to a recession?
No, we're going to go into a recession. We can't avoid that.
It's hell in a handbasket anyway, is what you're saying.
You guys stop laughing long enough for me to explain. The
you're
Fed,
funny.
all the damage that they've created over the past few years was because they wanted to avoid the recession we should have had in 2001 and 2002.
You mean the damage like the highest rate of home ownership? You mean the damage like adding $1 trillion of economic output since the credit crisis? You mean the damage?
Hold on, Peter. Let Mike finish.
Hundreds of billions of dollars in increased exports coming in. You mean the damage of corporate profits blowing through the roof? You mean the damage?
Okay. We get your point.
I could go on.
Gosh. You would have been a tough professor, Mike. Hold on, Peter. 1 second. We've got the home builders, and indeed, you are correct. They are pulling back, but they've had a good run. Nicole. When you look
Can I
at
comment on what Norman just said?
Well, no, wait, because I want to hear what Nicole has to say about the overall picture for somebody who's holding the credit card with a couple of thousand on debt, and then who's got an arm that's about to reset.
Well, I think, the person with the credit card and the debt, obviously this interest rate cut, it helps people with looking for home equity lines of credit, and ultimately helps usually with credit card rates. So that's good for consumers who are dealing with debt. Mortgages, it's a little bit more of a trickle-down type thing. It doesn't have such an immediate impact on the consumer. I mean, it will eventually, but it's not as immediate, and it won't make people feel great about their reset rate
and Liz,
in the weeks ahead.
Yeah, Mike, I got to address what you just said. You know, we achieved those record levels of home ownership by irresponsibly allowing people to borrow money that they can't afford to pay back. This is a disaster because so many people bought homes and borrowed money that they can't afford. We have not had economic growth. It's an illusion. The dollar isn't falling through the floor because things are so good. We don't have record trade deficits, record current account deficits, and a negative savings rate because we have a vibrant economy.
Just so
this is a disaster,
Peter,
Mike,
Peter, we get the point.
You can't figure it out.
Peter, we get the point, Mike.
In the past 4 quarters consecutively, Peter, the savings rate has gone up, and we have the highest household net worth of any country in the world.
No, we don't. You're dead wrong, Mike. You're dead wrong on that.
You are dead wrong. Look at the statistics, my friend. No. It's out there. Open your eyes. Take the blindfolds off. Stop.
Talking about taking the blindfolds off.
Okay.
Come on.
Gary?
How many things do I have to get right before you understand?
Gary B, go ahead, quickly.
At the risk of getting between this NASCAR race between these two, I want to go back to a point Nicole made. In fact, she's right about the mortgage rates trickling down, but as someone who holds an adjustable rate mortgage, they've already actually dropped about 10%.
You were pointing to yourself, do you?
Yes, I have an adjustable rate mortgage that was tied to the LIBOR, which is the London Interbank Offered Rate. Don't worry about the technical stuff. It's just tied to a benchmark, if you will. Those have already started to come down. I looked up today the 30-year, the 15-year, the kind of the conventional mortgage. Those have already started to come down. I think almost definitely the Fed will lower in December. They'll come down even more.
Guys, thank you very much. So as we near the end of the day on Wall Street, what can we say about the Fed's decision?
We welcome back our Fox panel, and I'm going to start with Charles once again. What do you make overall of the reaction that we saw with the markets, with gold, and just the gut reaction that you're hearing from CEOs like Mike Jackson of AutoNation and Ara Hovnanian?
Well, I think anytime you take some uncertainty out of the market, it's positive, and I think some uncertainty was removed from the market today. But as I was sitting there listening, to Mike and Pete continually battle out, I'm more convinced than ever that this stuff, this noise, has such little impact. And as an investor sitting back and trying to say, how do I interpret this information? You interpret it, again, by not getting overly excited about what happens. We always tell our clients, your investment should be boring, your life exciting. Never the other way around. But so many people try to glorify the investment game, and you can't do it. The markets are efficient. They're going to do what they want to do. Just take everything with a grain of salt.
Well, Liz, I'm not suggesting that your friend Warren Buffett is boring, but he does lead a very simple life. He lives in the same home he's been in for, 50 years? And he does seem to take that advice. So maybe if it's good enough for Warren Buffett and Charles.
No, I always say, where's the yacht, Warren? He says, you'll never see me with that because I know what I need, not what I want. And so Gary B., switching back to the overall Fed picture, Charles makes a great point. Tune out the noise.
Well, I guess it depends on your time frame. I think now would be actually a great time to start buying, if you haven't, financials. I saw housing stocks were down today. I think that it gives you an opportunity to get in. And I think the other reason is that I think the Fed, there's a great article in the Wall Street Journal, kind of behind the scenes how Bernanke works. Yeah. I think they were laying hints for another rate cut. They said two things in the statement. One, that they expect a further kind of contraction in the economy. And two, today's cut meant to forestall any problems that we have. When they use the word forestall, that tells me in 6 weeks from now, we're going to see another cut. I think we're going to have a choppy market. I think we're going to have an up market, choppy market till then. I think we're going to up market. And I think housing and financials.
Peter, I know you didn't want a rate cut today, but you got one. Were you expecting one?
I was expecting one, and, for the Halloween metaphor, it was certainly a treat for me. My gold stocks today are up 4 times as much as the Dow. Unfortunately, it's a trick for everybody else who's measuring their wealth in dollars and thinks they made money today. But I want to point out, your last segment was on credit cards. Credit cards are the next subprime. Just the way Wall Street securitized subprime mortgages, they do the same thing with credit card debt. The losses in securitized credit card debt are going to be enormous. A year from now, credit card interest rates are going to be much higher. They're going to be hard to get, and limits on credit cards are going to go way down.
Hold on. Can I ask you to clarify? They are also doing these bundled loans of other people's debt and then selling them to Wall Street?
Exactly. The only reason that it's so easy to get a credit card loan to borrow money is because Wall Street has been bundling up all these receivables and selling them to the Germans, the Japanese, the Saudis, everybody else, and there's going to be huge losses. There's no collateral behind these things. Okay. It's going to be a mess, and the world is not going to loan us money. They're going to cut us off. credit's going to be hard to come by, and Americans are not going to be able to shop
Nicole,
on
last
credit
word.
cards.